Now, in these tough economic times, analysts are advising taxpayers to take advantage of benefits by maximizing on contributions made. This includes saving in a number of products that will result in returns and rebates. For more on this, we are joined by certified financial planner at Alexandra Forbes Rita Cool. Rita, thank you so much for your time. I hear that the best way to do this is now sitting with retirement, annuity, pension funds and the likes. Talk us through that.
Good morning. Yes. People have until the 28th of February, so a month, to make sure that they have enough contributions in their funds to be able to get the tax back when they claim in a few months' time. So you can contribute up to 27.5% of your total taxable income, and you can get the tax back on that. Not only is that one avenue that you can do it in your pension fund, your provident fund, your retirement annuity, but you can also contribute up to 36,000 Rand into a tax-free savings account. And the nice thing about a tax-free savings account, even though you don't get the tax back on the contribution, your growth is also tax-free, and you can get hold of the money at a later stage in the emergency.
We all definitely need that extra little bit of cash, Rita, and it becomes important to then ask about the current trends that we are seeing, whether South Africans are jumping onto this particular trend to ensure that they make a little bit more.
Absolutely. It's something that wealthy people have made use of for years and years. And the nice thing is, because the contributions that you make, because it is not reducing your salary with the full amount that you contribute. So say, for example, you contributed 1,000 Rand, but your tax rate is 30%. Then your take-home pay is only 700 Rand less. So you get that 300 Rand extra in your pocket. And not only is the benefit up front on an ongoing basis, the tax that you get back, it's also the compound growth that you get. So you get growth on growth on growth, because the growth is not subject to tax. So there's no capital gains tax in a retirement fund, there's no tax on dividends, there's no tax on interest. And then by the time that you get to retirement, you have exponentially more than what you would have had if you saved in, for example, a bank account or even in a unit trust.
Is there the best way to do it in terms of the contributions that one would make to their RA or pension fund to maximize on these gains?
Yes, I would first start with an employer fund, if you have one, because the fees tend to be less. So for the same return in individual retirement annuity and a company fund, you will probably even get more benefit if you save it and you make either an additional voluntary contribution into your fund, or you increase your ongoing contributions. You will get more benefit from that because you have less in fees. Then if you are self-employed, for example, you will go into retirement annuities. There are very, very good retirement annuities out there as well. But that's the second step that I will take. And then at the same time, I would start building up that tax-free savings account, because you only get 36,000 Rand that you can contribute on a yearly basis. So the sooner you start, the sooner this thing is going to start working for you.
How beneficial is it to start early? And here I'm talking about employees that are slightly younger, taxpayers that are entering the job market and are not thinking retirement, but maybe a tax-free savings account. But if you have both, you win on both sides.
Absolutely. Look, the first thing that I thought of when I was 25 was definitely not retirement. So I completely understand. It's only when you get older when you start panicking about what you're going to have at retirement. But what I would suggest for the younger people out there, as soon as you start working, just put away something. And the quicker you start, the smaller the amount can be. And if you start putting this money away on a debit order, say 10% to start, the sooner you start to put that away, it's out of sight, out of mind. You are paying yourself first. And then this 10%, it might not be the correct contribution rate for everybody, but just as an example, this is really going to be powerful if you compound this over 20 or 30 years, because you have that growth on growth. So you can start with much less when you're younger than, for example, if you start in your 50s. Then you need a lot more to catch up because you don't have that time on your side. So just start someplace, and as soon as you get that salary, pretend you don't have that 10%, so that you know it is done, it is gone, out of sight, out of mind.
Thank you so much for your contribution. Rita Cool is a certified financial planner at Alex Forbes, talking to us on the business desk at this hour about benefiting from your tax contributions. That's how we wrap it up on the business desk. Back to Ayanda and Michelle.